Hello and welcome back to Global Value. In today's video, we are going to be performing a fundamental stock analysis of Apple Inc., ticker symbol AAPL. Apple has the world's most valuable brand and is the largest publicly listed business in the world. They have the largest market cap. Apple is also the number one holding in the Berkshire Hathaway public stock portfolio. Apple makes up 41% of their U.S. public stock holdings, making it Warren Buffett's largest position in Berkshire Hathaway. Warren Buffett has referred to Apple as one of the four crown jewels of Berkshire, along with Berkshire Hathaway Energy, BNSF Railroad, and Geico. And his investment partner, Charlie Munger, has called the business a great business that he expects to be really strong even 50 years from now, that in his words is ungodly well managed. So a lot of kudos to Tim Cook and all of his lieutenants at Apple. Almost anyone who's interested in business will know about Apple's founding by Steve Jobs and Steve Wozniak, which at this point is the stuff of Silicon Valley lore. There have been plenty of books written about it and a number of movies, including where Ashton Kutcher played Steve Jobs. So at the time of recording today's video, Apple is trading for $152.37 per share. Year to date, their stock price is down 12.5%. Over the past year, they're actually up about 4%. Over 3 years, Apple has compounded at a rate of 42% annually, so that is incredible. Over 5 years, they've compounded at a rate of about 31.5% annually. So again, huge numbers here. They've almost quadrupled over this time. Over the last 10 years, Apple has returned 20% compounded annually. And going back prior to the global financial crisis, they've done even better than this. So prior to the first iPhone being released in 2007, Apple has compounded at a rate of 31.5% annually for the past 17.5 years. Easily one of the top performing businesses over this time frame. And it's still a very strong company. To put that in perspective, they've increased their share price from $1.24 after being split adjusted in 2005 up to $152 today. So this is easily a 100-bagger business just in 17.5 years alone. That's outstanding. So Apple is about $30 below their 52-week high, and they're about $23 above their 52-week low. As mentioned, they are the largest publicly traded business in the world. They have a $2.5 trillion market cap. Apple operates in the consumer electronics industry. They design a wide variety of consumer electronic devices, including iPhones, iPads, Macs, Apple Watches, AirPods, and Apple TV, among others. The iPhone makes up the majority of Apple's total revenue. In addition, Apple offers its customers a variety of services such as Apple Music, iCloud, Apple Care, Apple TV Plus, Apple Arcade, Apple Card, and Apple Pay, among others. Apple's products run internally developed software and semiconductors, and the firm is well known for its integration of hardware, software, and services. Apple's products are distributed online as well through company-owned stores and third-party retailers. The company generates approximately 40% of its revenues from the Americas, with the remainder earned internationally. Recently, Apple's iOS passed Google's Android to be the number one mobile operating system in the United States. Apple Inc. was incorporated in 1977 and got its start the year before in 1976 and is headquartered in Cupertino, California. So for our fundamental analysis today, we are going to be performing the Select 6 analysis, taking a checklist-style approach of 6 standard financial metrics to come to a holistic and beginning understanding of Apple based off of their business fundamentals. This analysis is still a work in progress, and it's an opportunity to learn in public. It's going to continue to improve and get better over time. So with that said, let's get right into our analysis. Starting off with metric number 1, we want their average return on capital over the last 5 years to be above 14%. So the average publicly listed business earns about a 7% return on capital, and over the long run, over the course of decades, a stock is going to return approximately what its underlying business returns, and these business returns are captured here by return on capital. So Apple has steadily increased their return on capital in all 5 of these years. Over this time frame, it's actually more than doubled. Last fiscal year, they had about a 55% return on capital, and in their last 12 months alone, Apple has a 66.6% return on capital. Outstanding capital returns there. Averaged out, this comes out to being a 35% return on capital in a given year. This is a massive check. This is more than 2.5 times that metric we're looking for. The reason we look for that 14% metric for return on capital is that we can build in some margin of safety by only looking for businesses that are twice as good as average. Apple in an average year is 5 times as good as average when it comes to their return on capital numbers. That's 2.5 times better than that metric we're looking for. This is a massive check to start off here on metric number 1. Metric number 2, here we're looking at the high-level cash coming into the business, so we want their revenues, net incomes, and free cash flows to have grown over the last 5 years. This metric is all or nothing in nature. Either all 3 of these are going to be up for a check, or if even one of them is down, this entire metric will be an X. In the case of Apple, they've grown their revenues, their earnings have doubled over this time frame, and their free cash flows have just about doubled as well. This is another big check here on metric number 2, strong growth from Apple overall. Metric number 3, we're looking for earnings per share growth over the last 5 years. Here we're looking at the business on a per share basis, so taking the perspective of an individual shareholder. As we learned from our previous metric, their earnings have doubled over the last 5 years. However, their earnings per share have gone up even faster than this. What this tells us is that Apple has been buying back shares in this time period. In fact, Apple has bought back 22% of their shares outstanding in the last 5 years alone. This is important because when you're purchasing a share of stock, what you're really buying is a fractional ownership percentage in that underlying business. When a company buys back shares like Apple is doing here, they're increasing your ownership percentage of the business, which will increase your percentage of the business's profits without you having to spend a dime. It's as if the company is making an acquisition of itself, laying out cash to get an even higher ownership percentage back. We want businesses that are buying back shares when they're fairly, or better yet, undervalued. This has likely been the case over this time frame for Apple, so this is a great sign here. Strong earnings per share growth over the last 5 years. This is another check on metric number 3, and we are 3 for 3, starting off hot here. Metric number 4, we're building off of the previous 2 metrics. We're looking for free cash flow per share growth over the last 5 years. Over this time frame, again, they've almost doubled their free cash flows, and they've more than doubled their free cash flows per share because of those share buybacks. Over extended periods of time, a company's earnings and their free cash flows should be about the same, which is exactly what we're seeing here. And averaged out, we want to see this into the future as well. It's a great sign that Apple has checked the box on these last 2 metrics in tandem with having such high returns on capital. Businesses are able to grow these per share metrics relatively easily, especially when they aren't caring about returns on capital and they're outlaying cash at whatever rates are going to get them their growth. In the case of Apple, because they've had such high returns on capital and they're increasing these per share metrics as well, their growth is coming from prudent performance, and that is a wonderful sign, a trademark of a great business. This is another check on metric number 4, and we are 4 for 4 to start off. Metric number 5, we want their net debt, which is long and short-term liabilities minus cash and short-term investments, to be below the amount of free cash flow that they've generated in the past 5 years. Apple ended their fiscal 2022 with $54 billion in cash left over after paying all of their liabilities. And in this time frame, they've generated $341 billion of free cash flow. That might be the most amount of free cash flow from any company in the world over this time frame. And they have such a strong cash position. This is another massive check on metric number 5. Apple has an absolutely ironclad balance sheet. Finally, the big metric of them all, metric number 6, we want their average free cash flow to enterprise value yield to be above 5%. If this is the case, this will give us a risk premium to the risk-free rate, which will give us a reason to potentially be interested in the business. Currently, Apple has a $2.44 trillion enterprise value. Enterprise value gives us a more realistic economic picture of the business than market cap alone because it's incorporating both its market cap and their net debt position. So this is more akin to if Apple was a private business. And then as we learned in the last 5 years, Apple has produced $341 billion of free cash flow, which means that in an average year, they are producing $68.2 billion of free cash flow. So when we divide their average free cash flow of $68.2 billion by their $2.44 trillion enterprise value, that is going to give us an average free cash flow to enterprise value yield of about 3.3%. That's just in line where the risk-free rate is right now with the 10-year treasury. And unfortunately, that's coming in under that 5% yield we were looking for. So this is going to be our first and only X here on metric number 6. It's worth noting, however, that in the last 12 months, Apple has produced nearly $108 billion of free cash flow. So their current free cash flow yield, based off of their last 12 months of free cash flow of $108 billion, compared to their enterprise value of $2.44 trillion, actually does give us a 5.3% current free cash flow to enterprise value yield. Apple may not be as overpriced as what it would look like just from metric number 6 alone. So take that caveat into account. Keep in mind that just because this is an X doesn't mean that you're going to throw out Apple entirely. This analysis is holistic in nature. You want to take all these factors into consideration as you're beginning to understand Apple. Here we're looking at Apple's dividend profile. Apple currently only has a 0.6% dividend yield, which is well below that of the S&P 500 right now. But we learned that Apple looks like a rock solid business. And in these last 5 years, Apple has been able to steadily increase their dividends per share while also steadily increasing their cash flows per share and never paying out more than 40% of their cash flows as dividends. That dividend payout ratio has only declined even as they've increased their dividends because their cash flows have grown faster than they've grown their dividends. So if Apple continues to put up cash flow numbers like this, it looks like they'll have a very long runway to continue growing this dividend now and into the future and be able to healthily support it with their cash flows for a long time to come. Keep in mind that's no kind of guarantee, and this is a snapshot of the past, but it does look like their dividend is in top-notch shape here, and it's pretty easy to imagine that one day Apple could be a dividend aristocrat or even a dividend king. So Apple's dividend looks like it's in great shape. Finally, here we're using a discounted cash flow model to come to a potential fair value for Apple based off of their historical abilities to grow free cash flows. I want to make it very clear that these are historical assumptions that need to be validated or invalidated independently. You need to determine for yourself whether these are truly applicable for Apple here, and these are based off of their historical growth numbers. So in this discounted cash flow model, if we start with their free cash flows per share currently, then we assume a 10-year growth stage where the business grows at just about 14% annually for the next 10 years, and then have a terminal stage for the 10 years out after that where the business slows to a growth rate of only 4%. Then to get a 10% rate of return going forward on Apple over the next 20 years, it looks like a fair value for the business is about $152 per share. So that is only 25 cents below where their current stock price is at. So that is very, very close here. Again, these are based off of historical growth assumptions that are reasonably going to give us a baseline projection into the future. This is not guaranteed to be accurate. You have to do more work and learn more about the business to be able to understand whether these are applicable or not. So again, using these assumptions, it looks like you could reasonably expect about just slightly under a 10% rate of return going forward on Apple over the next 20 years. One thing to note is that this would be including dividends, and we would not be doubly counting their cash flows there. The big consideration here is that a discounted cash flow model is like any other model. You can make any sort of model say anything you want to about a business, so it's all going to depend whether your inputs are going to line up with reality or not. Keep in mind that this entire analysis is not financial advice. This is not a buy or sell recommendation of any security. And before making any investment, please consult with the properly licensed and registered financial and legal professionals. This analysis serves as a beginning, fundamental understanding of Apple as a business to help you determine whether it's worth your time to dig in and learn more about the business going forward. We'll talk in a little bit about what resources you can look at to learn more about Apple. So in summary, Apple checks the box on 5 out of 6 of our metrics. They're earning returns on capital that are 5 times better than that of an average business. They've grown their revenues, earnings, and free cash flows over the last 5 years, and they bought back 22% of their shares outstanding. Currently, the business also has $59 billion of cash left over after paying off all of their debt. However, our only X came when we were comparing their average free cash flows to their total enterprise value yield, which was coming in just at about the 10-year treasury right now. We did note that their current free cash flow yields over the last 12 months would actually be above that 5% metric we were looking for. So while Apple does have the largest market cap of any publicly listed business, it doesn't look like their valuation is anything near the stratosphere, and it could potentially be reasonable based off of their free cash flows. You've just got to do the work to learn more about the business. We also found out that their dividends are paid out very conservatively relative to the cash that the business is generating. It looks like they're going to be able to continue growing that dividend for a long time to come. Then, using a discounted cash flow model based off of historical growth assumptions for the business, we found that a baseline case for the future could give us about a 10% rate of return going forward on Apple over the next 20 years, if you believe that those assumptions are applicable and accurate for Apple's business. So as a value investor, you ultimately want to come to understand a business as if you owned 100% of it, and you can understand the essence of that business, knowing both its ins and its outs. There are a number of great resources to learn about Apple As with any business, I highly recommend diving into the business's 10Ks and reading through some of their recent quarterly earnings call transcripts. That'll help you get a better sense of the business's operating model. It'll help you understand potential opportunities and challenges that the business has now and will potentially have in the future. And it'll give you a better sense of how management is running the business and how they're approaching capital allocation. One book that may be helpful to learn more about Apple is actually reading through the biography of Steve Jobs by Walter Isaacson. That can give a better perspective of the business based off of the life of one of its famous co-founders, and it can help you understand the values that really make up Apple as we know it today. So then, just to reiterate, this type of analysis is not financial advice. It is not a buy or sell recommendation of any security. And before making any investment decision, please consult with the properly licensed and registered financial professionals. So with that said, that's it for today's fundamental stock analysis of Apple Inc., ticker symbol AAPL. If you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about Apple with me, and have a great day.